Everybody, thanks for coming out on this day that didn't look like it was going to be such bad driving. It was, but we're glad you all made it here safely. I'm Robin Scheu, the Executive Director of Addison County Economic Development Corporation, and our organization, along with Steve Paddock, who's standing here with the Small Business Development Center, are hosting this workshop today. So we're really glad to have you here. I'm going to give you a little overview of the workshop, introduce the panelists and some other folks, and tell you a couple of other things, and then we'll get started. So you all got the emails because you signed up, so you know that this is really talking about alternative financing resources for businesses. And it's not entirely all alternative. Our missing panelist, soon to be arriving, is Carroll from the National Bank of Middlebury, so that's sort of the more traditional bank financing, and so he'll talk about that. And what we're doing today is we're using as the framework for this conversation something called the Capital Continuum, and I think you all got that in your seat. Does everybody have a copy of this? You can get one. And Janice will be going over that to lay out the groundwork, because there's all kinds of funding, and the idea of matching the funding with what you need for your business, the right appropriate kind of funding, is a really important thing to do. So Janice will sort of set that up for all of us and talk about that. And then we've lined ourselves up along the Capital Continuum. So we're a visual display of this as well. pretty close to that. I'm actually talking about two things, and I could sit on either side of Dave, but that's the way we go. So we'll have about 90 minutes, more or less, of panel discussion. We've allowed this to go till 10:30, but about 90 minutes for that, and then we thought we will all stick around. And if you have individual questions about your business that you want, maybe you're thinking of one of these kinds of financing and you really want to find out more, that's kind of the opportunity to talk about that on a one-on-one basis, as opposed to taking up everyone's time with a long, involved conversation that you want to have with somebody. We thought that might be more helpful for you. So we hope it'll answer your questions. So I'd like to introduce the panelists. And so we have Michael Pieciak, and he is from the Department of Financial Regulation, and he's going to be talking about the Vermont Small Business Ownership Exemption. Moving along the continuum, Janice and Onge runs the Flexible Capital Fund, which is also sort of part of this Vermont Sustainable Jobs Fund, or a little bit separate, but she works for both organizations. She'll explain. David Parker is here from Community Capital of Vermont. We had Martin Hahn listed on the sheet, but David is here, so we're glad to have you.
Thank you.
I'll be sitting next talking about a couple of loan programs. Sandy Croft from VEDA, the Vermont Economic Development Authority. And then Ian Carroll will be here soon. So those are your panelists. I also want to introduce some other support resources that are here. You've met Steve. Steve, do you want to say a bit about the Small Business Development Center?
Sure. The Small Business Development Center is a statewide program that provides business assistance, technical assistance, advising, coaching, counseling around the state for no charge due to our funding through the Small Business Administration, the Vermont Agency of Commerce, the Vermont State Colleges. So we're available here to help with any of the business issues you have, and work closely with Robin on helping people put together loan packages.
Great. And then we have two folks from the SBA. We have Susan Mazza in the back of the room, and Chris Harriman sitting right here in the middle. Do either of you want to just...
I'll just do a little quick. I'm half standing up, and I just walked in. So. Susan Mazza, it's a federal agency. And we do a lot of different things, but one of the things is trying to help with resources and technical assistance through the SBDC, as well as the Women's Business Center and the SCORE counselors. But we also have many different loan guarantee type of programs and other contracting type of programs, many of which are actually facilitated by the panelists. And so I'm going to let them be providing the information about the actual guarantee programs. But many of the purpose of most of these, if not all of these, is to really try and help those who are having a hard time getting into business, getting the financing they need, or getting access to the contracts they'd like to, that we can help in that regard. And Chris Harriman and I both work out of the Vermont District Office. She's right there in the middle of the room, and we're available to answer questions or anything like that.
Great. Thank you both. We also have Brett Long from the Agency of Commerce and Community Development. He works directly with businesses if they've got questions about things at the state level, and I work with Brett a lot and refer business up to the agency for some of their programs as well. And then I want to introduce my staff. You met Diane when you came in. She's been doing the registration. Diane, can you come wave? She's also the one who sends out all the emails that you get. So she sends those out. And then behind the camera over there is Jennifer, who's our bookkeeper and videographer and many other things. We are videoing this presentation, so if you want to look at it again another time, you can. This is courtesy of Middlebury Community Television, MCTV. It will be up on their website probably next week sometime, and we'll have a link to it from our website as well, so you can watch it on your computer at any point in time. We won't be videoing the one-on-one conversations afterwards. The point of this is to get the information across, so the cameras will shut down at that point. So I think that's all that I need to say about that. Most of you found the bathrooms. If you haven't, they're in that corner, men's and women's rooms back there. And I think that's it. Are there any questions or anybody has anything? Not, Janice, I'm going to turn over to you to get started with the capital continuum.
Sure. Do I need to stand up?
You can sit.
Can everybody hear me okay?
Yeah.
So I'm Janice St. Onge. I wear two hats. I'm the president of the Flexible Capital Fund, and I'm going to talk a bit about that after I kind of do the overview. And I also am the deputy director of a nonprofit called the Vermont Sustainable Jobs Fund. Robin had asked me to talk a little bit about the breadth of capital and financing opportunities here in the state of Vermont. And at the risk of dating myself, I'm actually going to start with a little analogy. Back when I was growing up, which was a while ago, the Buick cars had the image of being your grandfather's car. It was this solid quality car. It wasn't sexy. It was just the standard car that you didn't want to drive when you were in high school, right? So last night I was watching TV and I happened to see this commercial come on, and this, people have seen this, but the woman's coming out of the restaurant. She's on her cell phone and she's looking around. She's on the phone with her friend and she's like, "Where are you? Where are you? I can't see you." And her friend goes, "Oh, I'm right here." And she looks across the street and sees this old beater car and thinking that's her friend. She gets in the car without even looking to see who's in the car. And there's this young college student looking at her like, "Lady, what are you doing in my car?" He's eating a sandwich. Like, "What are you doing in my car?" She's like, "Oh, sorry." And her friend's laughing because she's right across the street, right in front of the entrance of the restaurant, saying, "I'm here in the Buick," right? So her friend looks at the Buick and does a double take, and she comes back around and sits, gets in the Buick. She goes, "Wow, nice." So to me, that was the analogy of it's not your grandfather's Buick anymore in the financing scene. It really isn't. There's so many options and opportunities and ways in which you can finance your business from startup to growth stage to maturity that it's almost mind-boggling. And this really has been happening over the last probably 5 to 7 years. And so I thought that the Capital Continuum, this document that you have in your hands, is probably a quick and dirty way to just better understand the options that are out there. And it's not the breadth of everything that is out there. It's really more just an example of what's happening in Vermont. And actually includes some regional funders as well. But essentially, I think, as Robin mentioned, when you're looking at financing your business, I always say you really want to understand what's the right match of capital for you and your company and the stage of growth that you're in. So are you a startup business? Are you growing? Are you early stage? Are you mature? For the scale that you want to grow to, do you only want to sell in Vermont? Do you want to sell regionally? Do you want to sell nationally or internationally? And then also looking at the kind of financing that works for you personally as the entrepreneur. Does it fit with your values? Does it fit with your long-term goals? Do you want to grow the business until you retire? Do you want to sell the business? All of those things matter in terms of the kind of capital that you want to take on to grow your business. The other piece is, how are you going to use the money? So are you going to use it to buy a piece of property, a piece of real estate? Are you going to use it for a piece of equipment? Are you going to use it to hire new staff and to do marketing and advertising? All those are also factors in understanding what's that right match of capital. So if you look on the capital continuum, really what I try to do is show kind of what's the, as we know, least risky, least cost to most risky, probably highest cost or highest priced capital. Now, there are some exceptions to those rules, and I would say, for example, grant funders. I think they're the most risky but least cost because you don't have to pay the money back. But it's most risky to the grant funder because they don't really know if that entrepreneur is going to fulfill the mission that they've set out in providing that capital for. So just going from, we're going to start with lower risk, lower reward. And the other thing I'll say is the way this is really, from a visual perspective, shows that the line is really showing the kind of instruments or financing instruments that you can use. So for example, you can get a loan, which you have to repay. You can get a loan that's repaid not just on principal and interest, but maybe based on revenue. Or you can get equity where somebody actually invests in the company and they own a piece of that business, your business, and they actually may have rights to help you make decisions. They may have rights to be on your board. So from a more of a safer, lower cost instrument like debt, where you're taking on you've gotten a loan from a lender and you repay it on a monthly basis, principal and interest, whether you have the cash or not, it's going to be lower cost because the bank typically will want to take your assets, so they'll want inventory and receivables and equipment if you have it. But that helps protect them so that you don't pay them back, they can sell the assets and then get paid. And typically, with debt, mostly along the continuum here, they're also going to want a personal guarantee. And that means that you personally, if the business doesn't pay, you're on the line for that. So those are all things that reduce the risk for a lender, and which allows them to then provide a lower cost of capital. So it's all about this idea of risk and reward. The lower the risk, typically, the lower the cost of capital. The higher the risk, typically, the higher the cost of capital. So as you move up the continuum, in terms of you've got banks, and then you've got state and federal government lending programs and guarantees. You've got what's called subordinated debt. So that's where some of the alternative lenders come in here, where they provide debt. So it's typically a term loan, principal and interest over a period of time at a set interest rate. But they're going to be what's called subordinate to a senior lender, to a bank, which means that they may still take a lien on your assets, but it's going to be behind the bank. And what does that mean for them? Guess what? It's a little riskier, because now if you default and don't pay them, then the bank's going to sell the assets and they're going to take their money first, and then you're second. So understanding this idea of the more risk that the lender's taking in terms of a subordinated debt instrument, you may have to pay a little bit more for that money. So does everybody understand that risk reward? Going up the continuum, there's what's called royalty or revenue share financing, and that's the kind of lending that the Flexible Capital Fund does, and I'll talk about that later. But that's essentially, again, debt, but it's riskier debt because we are repaid based on a percentage of your revenue over time, up until a fixed amount of money that we negotiate with the borrower. So if you don't have revenue, you don't have to make a payment. So that's good for the borrower, but not so good for the lender. So that's riskier. We're really betting on the fact that you are going to grow your revenues, which means our payments are going to grow over time, and so it's really back-ended in terms of the payment structure. Earlier stage companies who have lower revenues are going to pay a lower dollar amount in the first couple of years, and then as they grow, the idea is, it doesn't always work this way, that you have the ability and the profitability to pay a higher revenue share payment and pay us back in the time frame that we set. So again, riskier type of debt. It's closer to equity than debt from the standpoint of we really don't know if you're going to grow the business the way you say you're going to grow it. So we put a lot of emphasis on understanding the management team's capabilities to grow that business versus collateral. So that kind of money is not collateral dependent, because typically if we get assets from the business, we're so far behind the bank and alternative lenders that it might as well be unsecured debt. So it's riskier, it's gonna cost more, but it's a more flexible payment structure, so you're not locked into principal and interest. So that's a revenue share component. Convertible debt, now that is closer to equity. So that's an instrument, and all, by the way, all the definitions are on the back of this. But it really, again, that's really an instrument that it's debt, but it has the ability to convert the lender's interest into equity at some point in time based on some activity that happens with the business. And then lastly, we talked a little bit about equity, and equity being an ownership position in the business. So again, oftentimes a business who's in a growth spurt may need 3 or 4 different kinds of money. They need debt to finance the real estate and equipment, because that's the least cost money. And they may need equity to finance things that you can't put a lien on, like marketing and people, growing your staff, et cetera. So I guess the other point I wanted to make was, don't think that I just need debt or I just need equity. You may need some combination thereof. And again, that's where it gets a little hard to understand, well, what is that right match? And that's why, in addition to funders here, we also have folks like Steve and David who can help you understand how to put that package together. The last thing I will say is, in addition to what I would call the instruments, the taking out a loan or getting equity in your business or getting a royalty loan, there's tools and networks out there. And that's the bottom, underneath the line piece of the capital continuum. So if you think about it, not everybody has in their back pocket, a list of investors who might be interested in working with your business. So there are networks in the state that can help you find those investors, and there's tools to take on that investment, and that's what Mike Pieciak's going to talk about, is the Vermont Small Business Offering Exemption. So broadly speaking, lots of ways to raise capital, lots of different kinds of structures that you want to make sure is the right fit for your company, depending on your values, your stage of growth, and your scale, and lots of tools to do that, and organizations out there who can help you facilitate that. So I don't know if there was any other points, Robin, you wanted me to make?
That was it, to just get people to have a sense of, there's a lot out there.
It's not your grandfather's Buick anymore. So.
Great, thanks a lot, Janice. And Ian Carroll has joined us from the National Bank of Middlebury. Thanks, Ian.
Good to see you. We need to share GPS.
So, glad you made it.
Yes, apologies. Often when traveling from Essex, I find that the GPS shortcut, not so much. It always leaves behind the school bus, so.
At least it wasn't a snowmobile path, which has happened to people I know too. So maps are sometimes a really good thing. So we're actually going to start at the high risk, high reward end of the spectrum, and then work our way up to the lenders, traditional financing at the other end. So Mike, why don't you talk about
I think I'll stand just because it'll be easier to see everybody and easier for me to breathe while I talk. But yeah, so I guess because we're the most risky, I get to go first, which I guess is also exciting as well. But I want to give a little bit of a background about the Department of Financial Regulation first, and about myself, just to sort of a baseline, and probably a lot of people aren't familiar with us. We used to be called VSHCA. Now it's the Department of Financial Regulation. We regulate banks, insurance companies, captive insurance, and then also securities, which are essentially investments, and then also the people that offer and sell those investments, so investment advisors and broker-dealers, people that work at Raymond James or Edward Jones or those type of Main Street brokerage firms. They register with us, and we do examinations on them. And then also businesses that are trying to sell investments in their business come to us and register their securities with the department before they go out and seek investment from the public or from their friends or neighbors. So my background was in law and in mergers and acquisitions. So when I came to this post about 2 years ago, I looked at the department, I looked at the securities division, and we had a really heavy emphasis on enforcement cases, on enforcement matters, so essentially going after fraudsters and bad guys, which is good and excellent and important part of the securities job. But there's another part of our charge which focuses more on capital formation and assisting the Vermont investment community and small businesses and and sort of coming together and being able to grow and raise money and expand jobs and expand their businesses. And that part of our charge had sorely been lacking for a number of years. So that was something we really wanted to look at and reinvigorate. One of the things we did was create a new position called the Director of Capital Markets, whose sole focus is on helping businesses inside and outside the state register their securities here in Vermont, giving outreach to small businesses, sort of a resource for those outside the department to come in and sort of a central focal point for people to sort of get information from and work with that person. So that's been an excellent addition to our department. I think it's made working with small businesses a lot easier. It's a resource for them. And then we also had to take a hard look at sort of our regulations that we had on the books, and that's really what I want to talk about is the Vermont Small Business Offering Exemption. But before I go into that sort of full-fledged discussion, I think it's helpful to get sort of a baseline, a little bit of what I'm talking about. So as a background and a primer, securities laws have been on the books in the United States since about 1911. Kansas was the first state to adopt a state-based securities regime. And the reason Kansas was the one to do so was there were a lot of farmers that were being taken advantage of by slick-talking, New York City types that would come through and huck securities that were worthless or that were next to worthless and say they were, the next greatest thing. So a lot of people were being taken advantage of and losing hard-earned money and losing savings. And Kansas stepped in and said, before anybody can sell securities in the state, they have to be registered at a central location, they have to be vetted, and then an investor knows, hey, this thing has been looked at by somebody. It might not be the best deal, it might not guarantee that I'm going to get a return, but at least it's been looked at by somebody. It doesn't even necessarily guarantee it's not a fraud, but at least there's some protection, some assurance that someone with some knowledge has looked at this and approved it before it's gone out. So that sort of took hold, and all the states adopted blue sky laws, as they were referred to. By the 1920s, though, the Great Depression struck, the crash of the stock market in 1929. The federal government thought, we need to have a federal regime as well as a state-based regime. The SEC was created in the 1930s, as well as the baseline for the federal securities laws. So ever since the 1930s, we've had the state and federal framework of securities laws, which complicates things for businesses because if they want to register their securities in a state, they have to go through the feds and the states, depending on what they're doing. And if you want to offer in multiple states, you have to go through multiple states and the federal government. So it added a level of bureaucracy and difficultness in terms of getting to market and getting your investment to investors. So through the years, up until very recently, the norm was to go through a full-blown registration process when you have securities that you're offering. That entails attorneys and accountants and cost. So it was something that was difficult, especially for small businesses that don't have a lot of money to work, to hire fancy lawyers or to hire accountants and things of that nature. So states, including Vermont, always tried to have an emphasis on helping small businesses navigate that process more efficiently. In the 80s, we had a really rich tradition of businesses raising money locally and growing to become very successful. Ben & Jerry's was the first company in Vermont to do so. They had a $750,000 offering in 1984 that was fully subscribed. With that money, they were able to build their Waterbury factory. The next year, they had a national public offering. So that's basically the most successful sort of example of this local investing opportunity that exists here in Vermont. Others in the 80s, like Catamount Brewery, Earth's Best Baby Food, also raised money locally at the onset and grew and became successful businesses in their own right. But when I looked and I got here, a couple of years ago, we said, there's been very limited activity in this area in the last 15 years or so. There have been about 14 offerings in the last 15 years. And we said, why is that? And I think the greatest reason was probably people were unfamiliar with the exemption. They were unfamiliar with the process. So we said we'll go about fixing that by going and talking to communities all around the state like we're doing today to inform them about the program. But also we needed to substantively revise it to make it more modern, to make it more useful for small businesses. It didn't contemplate social media, for example. It didn't contemplate the internet even. So those are obviously important components for any small business. So under the previous iteration of our laws, you were capped at raising $500,000 from local investors here in Vermont. You were limited to 50 individuals, so 50 Vermonters, and there was no limit on the number and the amount that an individual could invest into a business. And when I'm talking about the Vermont Small Business Offering Exemption, the one baseline I will say is I'm talking about Vermont businesses selling to Vermonters. So I'm not talking about an out-of-state business selling to Vermonters, and I'm not talking about a Vermont business trying to get investment beyond the borders of Vermont. When we're only dealing with Vermont, we're in a little bit of a better position because you only have to deal with your state securities regulator. It's a state matter only, and you don't have to deal with the SEC and the federal regime. So that makes it much more streamlined, much easier to get through the registration process or through the exemption process. So, we thought each one of those main prongs, the 500,000, the 50-person limit, and the unlimited investment were all wrong. So we sort of blew it up and rebuilt it and said, businesses should be able to raise more money. They should be able to raise $1 million, up to $1 million. If you have audited financial statements, you can provide investors, and you can go up to $2 million. There shouldn't be this cap of 50 people. In the age of crowdfunding and peer-to-peer lending, small amounts of money sometimes are from a lot of people instead of big amounts of money from a limited amount of people are the way businesses want to go. So we eliminated the cap on the number of investors. And then we also imposed some investor protection elements by saying you can only invest up to $10,000 unless you're an accredited investor, which essentially means you're a wealthy individual, and then you can invest any amount of money into that business. So along with those sort of structural changes, we also provided guidance about use of the internet, use of social media. Basically, the guidance that we put out, and it's similar to what other states are saying, is if your communications are directed towards the state, if they're directed towards Vermonters, then you don't run afoul of the federal regime. Basically, if you're using a website, you have to have some sort of landing page that verifies that a person's a Vermonter. You can decide how to do that, whether it's by IP address or self-certification, or somebody has to upload their driver's license. You protect the information and make sure that only Vermonters are looking at it. And then when you send out tweets or put things on Facebook, you really direct traffic back to the website. You mention there's an opportunity. You mention it's only for Vermonters, and you send them back to the website. So this was a way for us to really liberalize, the securities regime here in the state, try to sort of pump some life back into it. And it's been well received so far from the investment community and from the small business community. In the last 14 months or so, we've had about 7 offerings that were approved. So from the last 15 years where we had about 14, the last 14 months where we have 7, I think it's a pretty dramatic increase. The first one, just to give you a flavor of some of the businesses that have gone through the process, I think this will be the most illustrative and helpful. The first was a company called Village Builders, which was located in Lamoille County, I believe. There's a construction business that wanted to expand into real estate. They wanted to buy real estate, rehab it, own it, sell it, rent it. They wanted to do sort of all things real estate. But they didn't have the capital to do it. They had just made some large capital expenditures on equipment, so they couldn't get bank financing. So they decided to go the route of ISBO. And they were approved about a year ago, or maybe a little bit more than that. And when I last talked to Fred Martin, who's the president, over the summer, he said they had lined up a few $100,000 in investment. And what they're doing with the investment, they had the idea that they were going to buy real estate. They thought maybe it was going to be in the northern part of the state, but they ended up buying a lot of real estate in the Springfield, Vermont area, in the downtown area that was foreclosed and otherwise dilapidated. And they're rehabbing it, renting it out to renters, right in the sort of immediate community. So not only is there a good benefit for the, hopefully for the investor at the end of the day, but for the small business and also for that Springfield community. So this is a great, I think, example of how, the sort of virtuous cycle can work when you're talking about local investing. The other business is Phoenix Books, which is located in Chittenden County. They have 2 stores, but they also wanted to expand to Rutland. So in their expansion to Rutland, they did a visible offering, and their business wasn't one where they needed to have bank financing. They could have achieved bank financing, they could have done financing through other means, but they thought for their business model it was important to get community buy-in, especially in a community that they hadn't operated in before. So the Rutland community, I hear, has responded well and has, I think their investment structure is a little bit different, but they've responded well and gotten a lot of support. And I think, again, it's a good virtuous cycle of a business getting support from the local community that's going to help the business, it's going to help the community, and it's going to help the investors at the end of the day. So the other company that's just interesting, and it's the one that I know is raising money now, and it's the first one, although I think Janice might have something going on at the moment too, but it's the first offering I know of that was on a platform in Vermont, which is called SAP. It's currently being offered, and It's a company that is making, started by two young Vermonters, so I think this is another great example of young people starting a business, trying to raise money from the community. It's basically maple sap that they burn down to either soda, water, or seltzer, depending on the level of, burning out the sugar that they do. And it's really tasty, it's really sort of interesting, and they have, again, this is on a platform. This is the way that they're sort of getting community interest, getting investors, is through the use of the internet, which is something that's new and different than sort of the traditional model. So I mentioned that platform. Also, there's Milk Money, which is a second platform. Janice, who's here, is one of the co-founders of that platform. And that's another interesting, I think, component to this whole local investment movement, because we can only do so much in state government, particularly as a regulator. We can create the regulations, we can work and educate people, but really our sort of ability ends there, and it really is up to the entrepreneurial community to spread the word, to actually put pen to paper and assist one another in conducting offerings and sort of finding their way through the regulatory framework. So I think those are two interesting and really great developments as well.
Are there questions that you have for Mike?
I just one about, you were talking about sort of spreading the rules around spreading kind of the word about these sorts of offerings on social media. Can you talk a little bit more about kind of what the limits are and like what stepping over the bounds would
Yeah,
mean
sure.
in that context?
So it's really sort of a vague and murky area, unfortunately, but we try to bring like as much hard lines as we can. But just the basic idea is that when you're only operating in Vermont, you're not going over state borders, you're not implicating federal regulation. So anytime you use the internet or social media, obviously it's going everywhere across the world, but you have to use social media, you have to use the internet. It's unrealistic to think a small business isn't going to do that. So the SEC and states have sort of put out guidance and regulations and rules, and they're working on, the SEC is working on putting sort of better rules in place, and hopefully by this year they'll have them finalized that will make this process a lot easier. But as of now, there's guidance that's out there from them and from us that, if I were a small business, I would only put information on social media about, very generically about that there's an offer available, that there's an exciting opportunity available to Vermont residents only. Please check out the website for more details. And then at the website, I would have a landing page with some sort of verification, whether it's a driver's license or something that I can look at and say, this was a process in place that was designed to only make it available to Vermonters. I don't think the SEC or the states are looking at 100% certainty and making sure that no one outside the state ever hears about this. But it's really about the process in place, and are you really directing your efforts towards Vermonters and towards people of the state that you're offering it.
But would like third parties have any risk if, because the point of a lot of that social media promotion is to get virality. So if someone shares it and then shares more details, are they at any risk?
Well, if they have no interest in the offering, if they're sort of on their own saying, hey, you're an investor, I just invested in this thing, I want you to invest too, and that's not, that's outside the control of the business.
Mike, I wonder, is there a minimum investment that somebody wants to invest in the next Ben & Jerry's? Is there a dollar minimum? And then on the other side of it, if you're thinking about doing this as a business, there are some costs associated. It's not like the federal, but you probably wouldn't do this for a $10,000 raise.
Yeah, I think that's right.
So what's kind of if you want to raise, what's sort of the minimum you should think about if you want to raise to go this route? So
Ben & Jerry's, when they did their offering, their minimum investment amount was $126, which I think represented like 10 shares of Ben & Jerry's at the time. So you can go that route. The offerings that have come through, I think as Janice mentioned, the difference between debt and equity. You can do these offerings as either debt or equity. If you're doing them as equity offerings, the downside of doing an equity offering is that you're giving up some of your business and you're bringing people into your business that are going to have opinions of their own. So if you're bringing in 100 people that have opinions of their own, both managing that relationship or multiple relationships is almost a second job. And large companies that have multiple shareholders or thousands of shareholders have divisions of their business that are shareholder relations. So as a small business, I think that's an important thing to consider. So on the equity side, if you have a minimum raise, minimum investment amount that you can set, there's no minimum by regulation, but if you say you have to invest $10,000, then you know you'll probably, maybe you'll get 10 people to invest $10,000, and that's the amount of money you want to raise is $100,000. So that's a good way of limiting your shareholders, is by having a higher minimum investment amount. The other way is to do debt, and to have, when you're doing debt, you're not giving up a piece of your business. You're promising somebody that you'll return their money with interest, and therefore, there's still going to be people, I think, that are asking questions about how's the company doing, how are things doing, but you're not beholden to them in the same way as you are shareholders, and that might be a way of getting more people involved in your business without giving up equity and not having to put half your time into shareholder relations.
And is there a minimum threshold if you're gonna be going through this process?
Yeah.
I mean, you should be trying to raise what, at least
Yeah, that's a good
100,000,
question, yeah.
200,000?
So,
What's the?
yeah, I mean, I would say, if you think that you have a strong, one of the other key considerations, I think, is if you're a business that has a strong customer base. So if you're, a bakery that has hundreds of customers, if you're a bookstore that has hundreds or thousands of customers, and you have this natural well of people that you think are going to invest in your business, I think that's, in some way, gives you some idea of what, you should be looking at for an offering amount. I would say, I wouldn't say it's foolish to only raise maybe $25,000 through BISBO. 50,000 maybe is the sort of the key number I would see for a business looking to do startup. But then there's others that are looking to raise $500,000. So, I think maybe if you're talking about a few thousand, that's probably not the appropriate route. But if you're upwards of 20, 25,000, 50,000, I think that's certainly something to take into consideration, particularly if you think you have a base of customers that trust you enough to eat your food or buy your product, that they're going to trust you enough to buy a piece of your business as well.
I understand that Phoenix Books, when they went to Rutland, they did it as sort of a pre-buy
Yeah.
situation. Can you explain how that was done?
Yeah, so the pre-purchase is sort of, I think it's more attuned to like a Kickstarter campaign, if you're all familiar with Kickstarter. So Kickstarter is crowdfunding, but it's non-equity based. So here, as my understanding and my memory is that you would do a pre-buy, let's say $1,000, but you'd get a certain value more than that in store credits, maybe like $1,200 in store credit or something over a period of time. So it was a way of getting, early capital, a way of getting customers, a way of getting a customer base in Rutland to start talking about the business. So that's sort of the idea, is that, you get people to buy into your business. You get the benefit of the capital and knowing that you're going to have those sales on your books, in the
Yeah,
first
they use
year.
it to buy their inventory basically.
Yeah, exactly right,
That
yeah.
worked out pretty well.
Yeah.
Kind of like a CSA.
Yeah,
Yeah.
right, yeah. And you're not gonna go anywhere else to buy your books if you have a
Yeah, exactly right.
$1,200 coupon
Credit.
sitting
Yeah.
in your wallet, yeah.
Yeah, I think the same is true if you make an investment in a small business. All of a sudden, it's not just an investor, it's an ambassador to the business.
Right.
They're gonna shop there, they're gonna tell their friends to shop there, buy there. So there is that.
But that somehow
added
was
benefit
part
to it.
of, they had to go through the process of registering it
If they had-
as offering?
So if they had done, let's say they had just said there's gonna be $1,000 pre-purchase and that sort of it, then that wouldn't, there's no profit expectation from an investor. They're basically just pre-purchasing. But in their instance, I think there was a kicker that if you invest a certain amount, or if you pre-buy a certain amount, you're gonna get
More than what you
Yeah,
pre-purchased.
exactly right. So there was a profit motivation there,
Okay.
and that's what turned it into a security and not,
Okay.
yeah.
Thank you. I think one more question,
Yeah.
we could probably go all day on this, but I'm now aware of the time. Eric?
Just was thinking about these different online platforms, and my understanding is that with Milk Money, one of the services that they offer is that shareholder management piece. So if you had a bunch of people that are investing small amounts, you could sort of outsource that headache a little bit to the service provider. So I don't know if that changes the calculation in terms of minimum amounts. And then also I was curious, you mentioned there was another platform that one of these was
Yeah.
using, and what SAP was using, and what that platform is.
So the other, I think that's right, Eric, that having services like that provide those services at a lower threshold that doesn't take the founder off the main focus of the business and allows some other entity to interact, to send out newsletters or deal with questions on a one-off basis, makes the calculation a little bit different. The other platform other than Milk Money is called Design Book. And Design Book has a little bit different focus. Originally we're trying to do, and you're probably all familiar with equity federal crowdfunding. That was sort of the rave, and in a few months the federal crowdfunding regime will be in place. But Design Book was one of these companies that sort of tried to get on that bandwagon quickly in 2012 when the rules were, when the legislation was adopted. The rules weren't adopted until 4 years later. So they were looking more at a national sort of platform. They still do national offerings to high net worth individuals. But since we updated the regulations and they have an opportunity here in Vermont, they've also decided to look locally as well. So they're based in Burlington and they have a nice website that you can visit and look at, and they have a lot of information on, and I encourage you to do that as well.
So we have Janice here from Milk Money, and I actually haven't met you, so I'll meet you afterwards. But do you want to just say a 30-second of what you do?
A lot of it's been covered already. Well, thank you.
But you should all know who Janice is,
That's
right?
And thank you, Eric, for bringing up the piece that we do offer on the back end, the investor relations management piece to help the entrepreneurs. We see ourselves as helping entrepreneurs to figure out their capital strategy and helping them look for what is the best capital first and foremost, and figuring out if equity crowdfunding is the best thing for them. If it is, then we help them get their campaign up and running. We charge a $2,500 upfront fee. We don't take any percentage of what they raise, so whatever they raise is theirs. So we designed our fee to try to be in that sweet spot of $25,000 to $100,000 campaign. It doesn't feel too expensive to the entrepreneur. And then they could hire us on the back end if they choose to do their investor relations management piece. But we are working really closely with Mike and Christopher at the Department of Financial Regulation. We like to say that the DFR made all of this possible, and we're just trying to make it simple and affordable and easy to understand. So, and I've got lots of cards if I'm.
Good. You can put them on the table
Yes.
anytime you want. Thanks, Janice. Great.
Thank you.
So before I talk a little bit about the flexible capital fund and royalty financing, I did want to make one other point based on what Mike and Janice and Eric's question and Robin's question is. Raising capital is not for the faint of heart. It's a lot of work, and it's a full-time job. And so, again, there are a lot of resources in the state to help you understand what's the right match and then help you execute. But once you do take on, and we're really talking about outside capital, it's very different when you're running your business and you're self-funding and you're having mom and dad kick in and you're using your credit cards. Once you take on somebody else's money, then they have expectations of you. And whether it's a banker or us or an investor or whoever it may be, there are expectations. So it's really important that you understand what their expectations are before you sign on the dotted line. And then even though you may have the ability to have someone help you with that investor relations piece, you're always going to be the entrepreneur. You're always going to be the one that lender or investor wants to communicate with and know how things are going. So communication after you sign on the dotted line is really important, and I found that in our portfolio. We've done 15 investments to 9 different companies, and there are some who are really good at communicating and some who are not. And I hate being the mom picking up the phone and saying, I haven't heard from you, where's the payment, or what have you. I just want to make that point because I think no matter what kind of capital you have, it's really important when you're taking on outside money, and that's really what we're talking about, somebody else's money, they have expectations. So that's all I can say.
Can I just add one really quick thing? My name is Jess. I have a small business, and I did a Kickstarter for it, which was awesome and successful and really fun. On that note, there's a positive side to that as well. I was just telling Janice that there's a different sort of sense of responsibility and excitement about your business. I don't have any employees. I do it all myself. Kickstarter's there's no equity, there's no debt. But knowing that these people believed in me and my business really helped me mentally as a business person who's doing it all myself move forward. So there's a positive side to that as well, in the sense of the responsibility. I felt the responsibility, but in a good way. Okay, everybody, they believe in me, I can do it, kind of thing. You know what I mean?
No, that's a great point, and I don't mean to be the downer, but sometimes we don't think about that.
I think that's my job, actually.
Leave it to the banker. You're so nice. No, but you're absolutely right, because it's not just about the money, it's what comes with the money that counts. And that's been my motto forever. Because money, you know, you can sign on the dotted line and never see your lender for the next year, or you can sign on the dotted line and have that person be your best advocate. So again, knowing who's supporting you and then leveraging their networks is great. So you're absolutely right, that's a really good positive. So, Flexible Capital Fund, very briefly. We are a small investment fund that provides what I call near equity financing. We're the only lender in the state of Vermont that's specifically doing royalty or revenue share financing. So we're the only game in town. We are specific to certain market sectors because we're mission-based. So we're focusing on companies, growing companies in Vermont that are helping preserve our working landscape, that are building healthy food systems, that are getting us off of fossil fuels. So that's from a mission perspective, we're looking at agriculture, forestry, and clean technology businesses. So unfortunately, that kind of takes some people off the map. That being said, I'll talk to anybody because over the last 15 years, I've built a good network of understanding who are the funders out there, and I'm happy to help folks get where they need to go. When we first started, we recognized that there was this no man's land between companies that were early stage and growth stage. They had a good business plan, they had a really strong team, and they were in a growing market. But they couldn't get bank debt because they didn't have collateral or they didn't have sufficient operating history, and that we talked a little bit about that need for hard assets and how that reduces the risk on the bank's part. And yet they couldn't get equity investment at the venture level or even at the angel investment level because they weren't high enough growth, high enough margin, and they were only looking to sell in the regional market. But they were great companies, and they had opportunity to grow jobs, to be profitable. So the idea of bringing in a kind of capital like royalty financing where you're repaying your debt based on your revenue, and in the early years your revenue's smaller, so your payment's smaller, so any excess you might have paid in a fixed principal and interest payment can be put back into the business, was appealing. The other piece of this is, unlike equity, we don't take an ownership position in the business. We don't have a decision-making role on the board. We do have observer rights, and we're a hands-on lender. So I go to all the board meetings and advisory board meetings, so I know what's happening with the company, and I can help point them in the right direction in terms of our networks. But we're not going to take an ownership position. So we're not diluting the business owner's equity in the business. So we're kind of in this, we're a mix of debt and equity. So we look at a business when we're trying to identify whether we want to invest or not. More like an equity investor. We look ahead to where they're going versus a bank or a traditional lender. And I can say this because I'm a recovering ex-banker. So I am. 10 years at People's Bank. So don't hold that against me, just kidding. But unlike the bank's going to look at your operating history. They're going to look at your collateral. We look at things a little bit differently. We don't require collateral. And we don't require a personal guarantee. We like to have them. But if we don't, it just impacts our pricing. So we're not a low-cost lender, but we're less costly than getting an equity investment. So typically an angel investor is going to look for 2.5 to 3.5 times their money. So if they're investing $100,000, they want to see, let's say, $300,000 back. We're going to be lower cost than that, but higher cost than a 6 or 7% coupon rate on a term loan. So again, risk and reward. The other piece that we bring to the table is that technical assistance or business advisory piece, because I feel like sometimes we're taking on more risk than an equity investor because we're debt and we don't have any rights to decision making in the business. But we are relying on the management's team to execute in order to get repaid based on growing revenues. So even though we are debt, sometimes I feel like we're taking on an equity level risk. But that means that we need to bring advisory capacity and instant access to our networks, to the businesses that we invest in. So within the context of the organizations that I work with, the Vermont Sustainable Jobs Fund, which is a nonprofit and that manages the fund, we have two CEO advisory programs. One is called the Peer-to-Peer Collaborative, and that works with companies across the market sector spectrum, to provide them a 12 to 18-month program of what I would call an advisory board on training wheels, where there's a CFO, a CEO, and a COO that will work with that business to help them on strategies to grow the business. The other program is the Vermont Ag Development Program, and that's specific to forest and agricultural product companies, similar in nature in terms of working with the CEO to really think about strategies to grow the business, from everything from leadership to financial systems to understanding profitability. So we bring those assets along with our networks of other advisors like the Small Business Development Center, like folks from Community Capital. So we're going to help match that advisory component to the needs of the businesses that we're working with. And again, going back to how we invest, the most popular product is our pure royalty, where we lend you $100,000 and we say, okay, in 5 years we want to see, we want 2 times our money back, or 1.5 times our money back, and you pay a 2% share of your revenue on a monthly basis until we hit that 2 times our money. And once you hit that multiple, you're done. It could take you 2 years. It could take you 5 years. You could, at the end of 5 years, still be halfway through, and then we have to really think about, okay, now what? We haven't gotten there yet because we're relatively new. We've been around for about 4.5 years. But the point being, that's kind of the riskier end. We also do what's called a subordinated debt term loan, which for folks who want that known principal and interest payment, we can do that, but we would typically add a much smaller percent of revenue on top of that as our kicker for our upside. Because again, we're typically not just behind the bank in terms of rights to payment and rights to collateral, but we're going to be behind the bank and Aspen County's revolving loan fund and the Community Capital Fund and VEDA. So we're like 5th on the totem pole. That's risky. And we will come in and we partner with all the folks at this table. And we're typically that last piece of money that either the business can't get or doesn't want to get in equity. So we're an alternative to equity. We fill in the gaps. We play a role behind all of these other lenders as a subordinate lender. And we are going to look for that reward, that upside in the event that the business does well. We're a partner with the business. So the idea is for it to be win-win.
So is that based on net revenue?
It's based on gross revenues.
It is,
People
okay.
can play with net revenues.
Right, I know. Okay.
But there, for some types of businesses, there's certain exemptions from revenue that are taken out. Like we don't charge on interest income, or in a food manufacturing business that's selling to a grocery chain for free fills or something. That's negotiable, but it's gross revenues. So, I guess I'll stop there and we can always have questions.
Okay, David.
All right. Good morning, everyone. I'm David Parker from Community Capital of Vermont. We're based in downtown Barrie, and we're a statewide micro-enterprise lender. We service loans to low and moderate income borrowers who may not have collateral or credit history to qualify for traditional loans. We do startups. We're happy to look at anyone coming through the door. Last year, we wrote about $1.1 million in loans with an average loan size of $10,000. So that's quite a few businesses that we were able to help. We loan from $1,000 to $100,000. We recently have done a couple of $2,500 loans for a cleaning service, one for an auto detail shop, all the way up through to a catering business, bed and breakfast, $100,000. So we are able to go over that $100,000 threshold through partnership loans with other lenders, and we quite often will do that. Our rates are, Janice mentioned risk versus reward. We take a significant amount of risk with startup businesses, and so our rates run from 7 to 9.5%, with a 2% break for value-added Vermont agriculture products. We also offer business advisory services, and that is what my job is. So from the time the loan is closed forward, we work with the borrower from the closing table forward to help them implement financial practices such as QuickBooks trainings. We'll help them with human resource issues, with permit issues, questions, anything on a business owner's desk that sits there, collects dust, and is something that they don't know how to tackle. We will take that and try to research it and get the answers for them. So we work hand in hand with our borrowers from the closing table forward. So our process starts with a loan inquiry, goes through a completed application. We have 3 loan underwriters, loan officers in the office. So when you come through the door, there's 7 of us in the office, and your application comes through, there's going to be personal attention given to that, where oftentimes in the commercial world, nothing against Ian, but you don't know your underwriter. The underwriting is kind of this secret box at times that the paperwork goes into, and then eventually it comes out. You're dealing with your loan underwriter, who will prepare the loan documents and get them ready to go to the credit committee, and hopefully a recommendation of yes, we'll lend you the money comes out of that. So it's a streamlined, if the application is completed properly, it's a very streamlined process and relatively quick. 2 to 4 weeks if things are in order. So we work closely with the SBDC, local agencies. We are statewide. Our presence is heavy from Route 4 Rutland North. So we're working on a southern strategy to try to get the word out, because we want to be available to all Vermonters, all entrepreneurs. Let's see, what else can I tell you? Just a list of our current, we're very diverse in our portfolio. We have a long-distance trucker, we have a baby carrier manufacturer, a deli operation, craft brewers, bookstore, Main Street. We like Main Street businesses. Hometown helps the local economy. So I do have rack cards in the back and my business card also, so I'm happy to talk to you individually after this. So.
Questions, Janice?
Can I just add one more thing?
Yeah.
After questions, I
Oh.
realize I forgot.
Okay. Questions for David? There aren't a lot of lenders who go as low as $1,000, so it's nice to know that, that you have that,
Yeah.
which is great.
Yes.
Eric, I saw your hand
You can
up.
go first.
Would I have to come into the Barry office to apply, or do you have local people?
No, we have an online portal on our website where you would file an initial inquiry, and then we will email you or send you the documents. You fill them out, put the pertinent financial information and pieces together, get us a completed application, and we will come to you on the road to close. When the loan is ready, we prefer to have you come to the office, but we don't make you come half a dozen times. It would be,
Because it's a
once
bit
for
of
the
a hike
closing.
to go.
Yes, it is, it is. Yeah, but we're
You don't need
flexible.
them in our
We go
office.
on the road, yes, certainly. Yes.
Me?
Yeah.
Okay, do you have technical assistance for, and will you do loans for marketing plans?
We have, it's kind of a broad range of things that we can do, but yes,
Okay.
we are currently working on several marketing plans. We do some help with websites.
That's what I'm thinking, is
Yes.
somebody who needs to like just jump into that, but doesn't have the financing or the expertise to do it.
Yes, yeah, we have a list of providers that we've put together who are web designers, who, we have accountants, we have lawyers, we have, a team of people who come in and help give us, or provide technical assistance that's above and beyond us. So yesterday, I sat in on 2 marketing meetings where we had a marketing consultant there working with our borrowers, trying to figure out social media strategies and things like that. So we are really hands-on and try to be as helpful as we can to our borrowers.
Just had a quick thought on this. It was interesting to hear you folks were thinking about a Southern Vermont strategy, because that's something that I hear often, that it can be sometimes harder for statewide organizations to kind of connect in Southern Vermont. And one group that we've been seeing kind of have an impact down there is the out of the Strolling of the Heifers group. They've been starting a new accelerator incubator, I think called Wyndham Grown. So I think that's a nice connection point down there. But it's something that I feel like many capital providers and access to capital folks deal with, is how do you make that connection and get that handshake and engage those enterprises and entrepreneurs in Southern Vermont. So I'm excited to see that, and happy to hear any strategies that you guys, find that work.
We've looked at quite a few areas to put ourselves for visibility. And one of the areas that we're working on is the young professionals. So they're active in many cities in Vermont. Next week I'll be in Castleton for a young professionals meeting, 6 o'clock
with
at
downtown
night.
Rutland.
Yes,
Yeah.
yes, right, yep,
Great.
yep, with Lyle Jepson and the Rutland Economic Development Corporation folks. So we are working on something now that will allow us to have various satellite offices around the state as we need them. We have a partnership organization we're working with that has offered us space in locations around the state. So we're hoping to finalize that. That will allow us to come and meet with you in Springfield, Vermont, or St. Albans, whatever that is. So we have our main office in Barrie, but we'll be able to set up meetings and have a safe, secure place to talk to our potential borrowers. So.
And you can use our office in Addison County.
Well, thank
Any
you.
of you can, so I'll just
Thank
make
you.
that pitch.
Thank
Do
you.
that now. Janice, we'll pop back to you first.
Yeah, I'm sorry, I don't mean to belabor this, but one thing I did want to point out with the Flexible Capital Fund is we do not, unlike community capital, work with startup businesses, because royalty or revenue share financing is not typically a great instrument for that purpose, because if you don't have revenues and you're a startup, it really doesn't make a whole lot of sense. So, and plus you do need a business that has gross profit margins that can support that revenue share payment. So I just wanted to make sure folks understood that our real bailiwick and niche is in that early and growth stage component of the stage of growth of a business as you're ramping up and starting to grow, and you need to finance things that can't be collateralized, like people and marketing and anything related to that's not a hard asset. So the other piece is we typically, our investment size is between 100 and 300,000. We'll go up to 400,000 in follow-on investment for businesses, so we can do a little bit more than community capital. And finally, with regards to, just so you understand royalty financing and how it's structured, people do it differently all over the place. There's more of an art than a science, and every deal is different because it depends on the growth rate of the business and their revenues and the risk that's entailed. But royalty loans don't have an interest rate. It's a percentage of revenue over time up to a multiple, meaning you're really looking at what's the overall internal rate of return on that investment over a 5, 6, 7 year period. So there's some nuances on the accounting side when you talk about royalty financing, but I just want to make sure folks knew that we don't charge an interest rate. We may get 2% on our money over 5 years or 30% on our money over 5 years. It just depends on the entrepreneur's ability to execute.
All right, I'm wearing two hats today, and for my first hat, I'd actually probably be on the other side of David, but this is the way it goes. I wanted to talk to you about a program called Kiva Zip, and Addison County Economic Development is the only trustee in the state of Vermont to endorse loans that go through this Kiva Zip program. So it doesn't matter that our territory is Addison County for these loans, we are statewide. And so that's been a nice thing. We became that trustee last summer. So Kiva, some of you may have heard of Kiva. It's a global nonprofit organization based in San Francisco, and a lot of people around the country that when I've talked to them, have invested personally in Kiva because it's a way to make loans to interesting businesses worldwide. Kiva Zip is a program within the Kiva organization that provides 0% interest loans for small businesses and entrepreneurs in the United States, and it's a crowdfunding. So Kickstarter isn't a loan, it's more like a grant than a crowdfunding kind of grant. This is a 0% interest loan. So that's pretty cool. They have 3 principal aims in this program. The first is to expand access to capital to businesses that wouldn't otherwise be able to get it. So if you're actually bankable, you wouldn't go through a Kiva Zip loan program to do this. But it's a way of, it really looks at a borrower's character and reputation. That's what it's about. You're not putting up any collateral or anything like that for it. It's a way to lower the cost of capital for small businesses, 0%, can't get much better than that. And finally, it's a way to connect entrepreneurs with a global community. So they're really looking at that. And they're actually also looking at making a community impact. I saw examples of some businesses that they did, and one in another state was a local barbershop, which, you know, when you think about your community, barbershops can be a pretty important part of your community. So I thought that was pretty cool. So loans can be used for any business purpose, and so it could be for hiring staff, it could be for investing equipment, or purchasing inventory. So some of the traditional things that you might borrow for, but sometimes you don't borrow money to hire staff. I have some examples of, if I can find a piece of paper, of what people have borrowed for. A $500 loan to pay for a stall at a trade fair for an artisan jewelry maker. So, you know, you can imagine somebody at a farmer's market or something that wanted to put something up. $1,700 loan to purchase new labels and 3 months of commercial kitchen fees for a pesto maker. Buying a computer, to buy items for a pickling business. Purchasing a van, $5,000 to purchase a used van to cater bigger events for a baker. So it's really kind of all over the map. The minimum loan size is, I think about $500 for you, and then the maximum that they do is $20,000. And you can go back multiple times, but the first time you borrow, if you use the Kiva Zip program, you can borrow as much as $5,000 the first time around. And then if you pay that back and you're a good borrower, then you can go back for more at other times. So the way this works is that there are certain requirements that you have to meet. I left material about this over on the table, so I'm not going to go through all the details. You have to be at least 18 years old. You can't. You have to have income limits. You can't be in bankruptcy, and things like that. So there's a few things that they have. And once you apply, then you get an endorsement from a trustee. And basically what the purpose of the trustee is, before you go out and people are going to lend you money at 0%, they want to know that the business that you've got makes sense and that has a realistic expectation of being successful, and so that's where the trustee comes in. And when I learned about this program a year ago, I thought this would be a great opportunity for us to play this role, because we operate revolving loan funds. But our revolving loan funds, which you'll hear in a minute, don't cover these kinds of things. We don't do small loans of $1,000 or $5,000. It just doesn't make economic sense for our organization, for most organizations, to do this. But here's this whole infrastructure already set up. But we can look at business plans and we can say, yes, this seems to make sense, endorse them publicly online, and then you go out online and then you collect the money through the crowdfunding. One of the requirements, before we get accepted, we had to be accepted as a trustee. And we said, you know, what's the due diligence that our organization's going to do before we endorse somebody? And so one of our requirements is that a business actually works with a business advisor, a reputable business advisor, to help them. So specifically, that could be Steve Paddock with the Small Business Development Center. It could be somebody from SCORE. Obviously, you seem to provide technical assistance. Whatever a credible business advisor would be, it's, you know, probably not your brother-in-law, but it's, you know, so maybe it is, but, you know, unless he's a CPA. Right? And so that you really understand what the implications are and you know what it's about, and then we're very clear on it, and then we can go ahead and endorse it. And then we also require, you've heard a lot of people talk about technical assistance, that's an ongoing thing. It's not you just get the money and go away, and you know, you really need that ongoing technical assistance to be successful. So we ask that you continue that relationship with your business advisor and meet with them at least twice a year, and maybe that you need to meet with during the course of the loan. So when you work with a business advisor, we endorse you. There's a private fundraising piece that you have to do, and because they want, because this is crowdfunding, they want you to invite friends and family to lend as little as $5 each, which shows the rest of the world that's going to invest in your business that you have a support network and that it is a credible business. It just sort of goes back to that feeling responsible. It's sort of proving that you're responsible within your own network. So depending upon the amount you're borrowing, it may be as few as 5 lenders or as many as 30 lenders of friends and family that you get to invest, as I said, as little as $5. They don't have to fork over a whole lot of money if you don't want them to. And so that's the private fundraising piece, and then it goes public on the website. And what Kiva tells us is that 95% of their loan requests are funded. So that's actually a pretty high. I don't know what the rates are for other ones, in terms of Kickstarter, Indiegogo, or what the other ones are. But that's what their success rate is, which is pretty great. And most of their loans pay back. And so they have a very good record and a reputation for doing this. So I'm really excited to do this. We're working with a business now that I think may be our first one. It's been interesting. There's been people asking about it, and then they haven't actually followed all the way through, but I think we're pretty close to getting our first one. So you maybe hear more about that sometime, and that'll be a lot of fun. And you can use this for developing marketing plans, or you want to upgrade your website, or any number of things that you want to do. So that's Kiva Zip. And as I said, there's material over there, and there's some more on our website. You can go to the Kiva site and get more information as well. Any questions about that one? Okay, I'm going to switch hats. Addison County Economic Development, we do offer revolving loan funds, as others have said. I also am a recovering ex-banker. I worked for a large multinational bank in Boston many years ago that got eaten up by Bank of America. But it's really fun to be able to do these kinds of loans now. When I worked at this large bank, this wasn't the kind of work that we did. And so this feels much more like local and community lending and much more about relationships, and that's the fun part of it from my standpoint, and probably for all of us, really. So we have a number of revolving loan funds. We get our funding from the USDA Rural Development, so we do have certain requirements. We can fund up to 40% of a project up to $100,000. So $100,000 is our maximum loan. We need to have a senior lender involved in the game, or two. I often work with VEDA and with the National Bank of Middlebury, and specifically with these two, on a number of loans. And so we're behind, as Janice said, we're behind. If we're in second position, I'm elated. Often we're in third, fourth, or fifth position, so there isn't much left. So they are character loans. It's all about you guys. We look for job creation or job retention when we do this kind of work. That's a lot of what we do. So some examples of businesses who've given me permission to talk about them. I only do this with permission, but the very first loan that I made when I started 7.5 years ago was to Aqua Vitae, which is the kombucha company many of you are familiar with. I made an $11,000 loan. I worked with Bill Roberts at VEDA. He was in his basement in Salisbury, and we were buying some more equipment for him to ferment. And I just love this story because he then outgrew his basement, and he moved to Bristol and had a much bigger operation and thought he could be there for a long time, and he started growing and growing and growing. He's outgrown that, and he's moving to Middlebury, where he's co-located with some of Vermont hard cider. He has made use of, he's a great example of making use of multiple kinds of funding. He's almost gotten one of everything that there is to offer in the state. And we had a workshop a few years ago where we had all the people that were involved in helping him grow at a table, and there were more people than are sitting here, many more. So when Janice talked about it's not just one kind of funding, there's many kinds. They really made use of a lot of them and figured out at the appropriate times what they needed. And so that's really exciting. We've done startups such as Stonecutter Spirits, helping them with working capital and inventory purchases. And we also helped Danforth Computer, so when they, not computer, computers, computer, I got the computer part.
That's a new one.
I know. Danforth a few years ago bought another pewter company, and so we helped them finance that, and I think the I think Vermont Community Loan Fund was involved with us on that one. The National Bank and VEDA were involved with us with bow ties. You're probably familiar with them, when they had an ownership transition a few years ago, and so we were involved in that as well. So we do small startups, and we also do larger, more established companies, but that aren't fully bankable. So a bank may say, great, we're glad you want to buy this equipment, we're willing to lend 50% of the value of the equipment, so you still have this gap. So they might ask me to come in and help finance 40% of it, and then the company puts down another 10%. So we've done a lot of those kind of deals.
Can I just ask both of you, just in terms of the rationale of a bank making that decision, why would a bank only guarantee 50% of a solid, potentially saleable piece of equipment? Why wouldn't they be like?
Well, they might be.
Okay.
You want to do it? I can answer it for you, but you better read it. Another former ex-banker.
Exactly. So there are a lot of reasons why a bank might want to have involvement with other organizations. Some of it might be that the amount of the request just is higher than what the collateral value is or what the bank is willing to lend. So, or if the situation might have some risk to the bank, that by adding another co-lender, it reduces the overall exposure for the bank, a deal that they actually believe in, but just can't do the full amount. By bringing another lender in who would be behind the bank, it gives the bank a little bit more of a comfort level, saying, okay, well, we're really on the hook for this much. We're going to help them get to where they want to be, but this is just a way for us to get that deal done.
Is it sometimes because it's limited use equipment? I mean, there are always.
It can be. It can be. It can be that construction is one of the first things that I can think of right now, because I just went through a big deal. Construction these days is an area where the cost of constructing something or adding an addition to your property well outweighs what the actual value is. So the bank really wants to do the deal because they believe in what that construction or that addition is there, but we can't fund the whole thing because we can only fund, a percentage of what the actual value is when the project's done, an appraised value, right? So there's that gap that's there. So by adding other lenders, there's a way for us to help try to fill that gap and still get that deal completed. It's the same way with if it were a specialized piece of equipment, or it might be the same way if you're acquiring a business and there's a limited amount of collateral that the bank might view. There are ways for us to try to package something together so that in the end we can get you where you need to be. We just don't take the 100% of it.
What about goodwill? Is that part of it?
Nah.
Nobody wants
Like
to.
everybody was going like this.
That comes up often, yeah. So goodwill is something that you probably should think about where those other sources are.
That way.
Or, I mean, other collateral. Goodwill
Right.
doesn't bring collateral to the table. You're buying a big piece of equipment or a building, that provides collateral.
Right.
Goodwill doesn't. But maybe there are other unencumbered assets in the business. Maybe you own unencumbered assets personally, equity in your house. That's where we get creative.
Right.
Eric?
I may have misheard, but it seemed like we were talking a little bit about loan guarantees and then also talking a little bit about loans. And so I just wanted to sort of mention that depending on what you're doing, there's some situations where another party would come in and provide a guarantee on that loan, and that's another thing that could increase the comfort level for banks. I don't know if you wanted to just sort of note that.
Sure, yeah.
Explain that briefly, just so people know that side of it, or who some of the partners are for that.
Sure. I mean, we've talked a little bit about the fact that banks are for the most part 99.9% of the time going to require that your personal guarantees in there. There are ways that you can add additional persons that might be guaranteed. They may not necessarily be owners of the business, but they might be able to be, they might be on the loan with you as guarantors, and if they have some strength that they bring to the table, that certainly helps adding to that package quite a bit. There are the loan programs that we work with, specifically like with VEDA, with SBA. Those are deals that we look at that bring in additional guarantees. The SBA in particular is one that we work with that guarantees not necessarily for you, the borrower, but guarantees for us, the bank, that if for any reason at the end of the day you can't make those payments and we have to look at a liquidation scenario, SBA will step in and help resolve some of the shortfall that the bank will have. So that puts us in a position saying, okay, this deal has got it's a good idea, it's what we want to invest in, however, there are some issues here, so this way we know we can kind of compromise, kind of hedge our bets a little bit, knowing that if things do go south, we're really not on the hook for the full amount that's there, because SBA will step in and help us out with that. So there are ways of packaging all of that, and you know, you're a good local lender. Local lender will certainly help you with that.
That's right. So, do you want to talk a little bit about some of your programs?
Sure.
Your entrepreneurial one and others?
Sure, and I think to kind of get to the lady's question a little bit, everybody here has policies that they need to follow. And a lot of those have to do, they have to do with all sorts of things, but to the question that you had, we all have policies on how much we can lend against different types of collateral. And as you go up the continuum, we're all allowed and able to take more risk, less risk against those collaterals, or in some cases lack thereof. So the bank policies in general, generally speaking, they're gonna be able to lend less against a piece of collateral than, say, those of us down at this end of the table, and that's why they bring us in. That's where we come into play. So there's my segue. VEDA works in conjunction with banks and the other lending partners here to put together a loan package. Kind of our typical structure is where the borrower brings 10% to the table. A bank would do a 50% loan, and we would pick up 40% in a subordinate position. As a subordinate lender, we do need collateral to secure our loan. As I referred to on the goodwill question, we'll look at the business assets, but we'll also look at assets outside of the business if that's what's needed in order to make the package work. We have a slew of loan programs out there that can cover almost every type of business and funding use. And depending on what your business is, what your use of funds are, depends on which program you can fit into, and will depend on what your interest rate and length of loan would be. VEDA has a mission to grow jobs within the state. So our loans are only for businesses that are operating within the state for those Vermont locations. So we can help any type of small business, but we can also help some larger businesses for their Vermont locations. We have a direct loan program which helps with manufacturing, warehousing, some travel and tourism type businesses, a whole slew of other things, but very specific. That loan program has an standard interest rate of 3%. So it's a little counterintuitive to the risk rate situation. We are very careful and diligent at looking at funding sources that allow us to keep our rates as low as possible. In some cases, if the job growth is significant enough, we can subsidize that further, but the 3% variable is the standard on that one. We have a small business loan program, which is kind of, I say my catch-all. There are very few businesses that don't qualify for that program that I can think of, aside from maybe a farm, but then we have a separate lending group that can do ag loans. My small business loan program can do loans now up to $500,000 on our portion. We just approved that a few weeks ago. That loan program has a 4.25% fixed rate for the first 5 years. If you go beyond that, it's variable at an in-house index. The direct loan program that I started off with can go up to $1.5 million. Again, on my portion. So you put that in conjunction with Ian, and that's quite a large, that's a over $3 million project.
Is there a minimum?
There's no hard and fast minimum, but there are loan fees that make it, we'll say, not exactly cost effective. If you are looking at anything really much below, say, 30, 40, 50,000 on the small business loan program. On the direct loan program, I'd say, I don't think you'd want to do anything a whole lot less than 50,000 on that one. Because then the loan fees just really frankly outweigh the benefits.
When you say direct loan program, define that. I mean, are you doing it without anybody else involved, or do you
It's just
only
the
do
name
loans
of our
for-
loan program.
Oh, okay.
That's the name of the program in-house.
Okay, so do you do direct loans to people without anyone else involved, or do you only work as a unit with a
We
company?
work 90% of the time as a unit with somebody else. There are a few times when we work on our own. Those very small loans, the 30, 40, 50,000 in my small business loan program. I can do those on my own without a partner. We have a program for energy generation. If you're doing a solar farm or a net metering project, in those cases, we can do loans on our own. But we're only doing 40 to 50% of the project. Typically, the developer putting the project together is providing the rest. And then on our ag side, they will do projects on their own. I'm a commercial lender, that's why I say they. When I refer to ag, it's not my bailiwick. But I can put you in touch with someone whose it is, if that's what you're looking for in a loan. So the majority of the time, we're working with a partner. One of our other loan programs that I wanted to make sure I touched on was the SBA 504 loan program. And that's a loan program where the company is buying hard assets. You're buying big equipment or you're buying real estate are the main purposes for that loan program. Again, in conjunction with a bank. My loan gets an SBA guarantee, gets sold on the secondary market as a debenture or a bond. And therefore, the borrower gets a fixed rate for 20 years. But it does come with prepayment penalties. There are only certain types of loans that can qualify, so it's a great loan program in certain circumstances. That would make sense to talk on a case-by-case scenario. And then the entrepreneurial loan program is another one where sometimes on our own, and that's a loan program that has a higher interest rate because it is a higher risk loan program to help people get going and start it up, often in a technology-based field.
So I actually worked with one of your colleagues on one of those a year ago, and we did a small piece of it, and because this is a special program where they've decided they're willing to take more risk, a lot of times technology companies, there's not, in terms of collateral, there's just not much there, and you don't know how well things are gonna succeed, but, so we did a joint project, and we actually lowered the amount that we borrowed because they were able to take more of it because it was a special program.
Right.
So it's nice to have that, that's pretty new.
It is.
Because a lot of tech-type companies have had a hard time finding places to borrow, and it isn't always the right thing to get equity, so.
That's right.
So this has been a nice program.
We always require personal guarantees, and we will look, on those situations, even in the entrepreneurial loan program, we will look at things like equity in your house, if there is any, to help shore it up. I open up any further questions.
Let me go to Ian. You get to refute anything anybody has now said.
Please mark the bruises on the right side of the face.
love our banking.
Yeah.
We do love our bank.
I do not aspire currently to be a former banker. I actually enjoy my job.
Yay.
So I guess part of my job here today is kind of dispel a couple of myths. First of all, so my name is Carroll. I'm a commercial lender here at National Bank of Middlebury. My office is right just across the street here on Main Street. I work, while I do commute and poorly with GPS assistance from Essex every day, I do work out of Middlebury every day. So I'm here pretty regularly. Our region is, if you're not familiar with National Bank, we actually have a northernmost tip in Heinsberg, so we touch on Chittenden County, and then we go as far south as Brandon with all of our whopping 5 branches that we have, okay? We are a bank that's been here for over 100 years, so we are a community-based bank. My former life, I actually worked in a national bank organization and chose to come to National Bank of Middlebury when they were kind enough to offer me the position. And it's been an outstanding change for me personally. One of the reasons why is that why I feel that that there is a place for national banks, and there certainly is they have a great value. One of the things I like the best is I get to play a role that's very similar to like everybody else here on this panel, but do so in the banking industry. So relationship is a really big key for us, and I say that not facetiously. I'm saying that it's a really good idea for any of you who are looking for any kind of assistance at all, is to get to know your local banker and have a relationship built with them, because that does play, it does still surprisingly play a key role. We actually, as a community bank, will rely heavily on what we know about your business and the history of your business, and truly having an understanding of where you've been, where you are, and what you're planning, and where you're planning on going. And it does play a part. We can't always say yes because we believe in what you're doing, but it does help us kind of push towards that yes if we can. The biggest myth that I want to make sure I dispel today is that surprisingly banks want to say yes. So just know that that's the case. We actually have a fair amount of money that we would like to lend. So if you're in the need of borrowing, please come see us, because we really do have a lot to get out the door. We are a traditional lender, which means that basically we are very heavily collateral based, right? So we're going to look and see what it is that you're acquiring, or what the project specifically has, and what we can use as assets. Don't think that if you have $100,000 worth of inventory that we're going to be able to lend $100,000 on that inventory, because banks are going to have to discount whatever you have as your assets, because by the time, if we ever had to liquidate that item, when we go to get that item and finally sell it off to repay our loan, it's probably not going to be worth what it's truly worth on the open market, right, when you purchase it. So we do discount what you have for your assets. If you're unsure about what those discounts are, or what a bank will advance, go talk to your local lender and ask them, if I'm thinking about buying this, how much can I borrow for that? We do work regularly with other alternative methods. We work very regularly with VEDA, with SBA. We'll work with it. We have situations where we have borrowers that have VEDA, SBA, and several others with Janice and the community loan fund. These are all areas that we actually partner up with and have to account for. We actually will seek out ways if there's a project that, like I said, we truly believe in. If we can't necessarily do it ourselves, we'll look for ways. How can we get this deal to fit in puzzles? We often work with Robin Scheu and the ACEDC, and that's something that we view as a valuable resource. So don't think that just that a bank is there to say we're either going to do it or we're not going to do it, and if it's no for just because the bank doesn't want to touch any of it. Your lender will actually work you through and say, well, we could look at this direction, we can look at that direction, and help you understand where the bank is coming from. That said, we're a traditional lender, so there's not a lot about us that you probably don't already know. I think it's probably best that I do a lot better if you ask me questions than I stand up here and kind of spout. So go ahead.
My question has to do with, let's say, for my small business, that I want to buy some real estate where I can locate my shop. And my shop might be anything from like an overhead door where I'm going to keep inventory and pull trucks in and stuff like that, to possibly a showroom, to office space. So it's a multifunctional building. Let's say located a lot that has a building on it that's half usable for the purposes,
Sure.
not fully usable. Let's say the person that owns that lot is willing to sell it to me and he can finance it.
Mhm.
Maybe I want to do that, maybe I don't.
Right? Yep.
For valid reasons.
Right.
Right. And let's say that, you know, he's got all kinds of ideas about what can be done there, ideas about the permitting and so forth. And not just verified.
Right.
And as soon as I go into the public world, such as you or somebody else, and all this stuff's gonna have to get checked out, right? Everybody's gonna wanna collateralize this, they wanna make sure that they know that their collateral is secure. And so that complicates the negotiations, you know, with this other person who really, you know, might actually like to get rid of this because he may not really have a good ideal use. It might be a really good ideal use for me. And, you know, I began looking into that a couple of years ago with my local lender. I didn't take it anywhere. At the time, I believe I was 20 years and 4.5%, as long as I had 20% down. Well, 20% of 400,000, which is what I figured it was going to be, because I was going to have to put at least 150 to 175,000 into water and extra building. You know, was more than I wanted to just cough up off the top of my head. But I have an established business with an established revenue stream. And, you know, I'm paying like $1,200 a month in rent right now in a place that's patently inadequate and that's inhibiting my growth. And there aren't a lot of places left to do this here, you know? I mean, I can't just go down the street and find some place to move into.
Right.
You know, I have a very specific operation. So I know what I'm looking for, and I know I've seen about 3 places in 5 years. So it's I'm asking really you, but also the table, because I'm imagining that this probably starts with you and may or may not end up going down the line.
Very well could.
You know, and you probably can't answer all the questions, and there's probably a lot more than can be done right here. But how would I be best advised to approach a project like that?
Sure. That's a really good question. So, from what you just told me, it sounds to me like there are ways that we could package something together for you. 20% is, so one thing to know in commercial lending, as a commercial lender, typically if we're gonna do something, a real estate deal on our own, we actually, our policy is 25% down, rather than 20% down. Unlike your residential, we actually want you, on the commercial side, we want you to put a little bit more skin in the game to reduce the risk on the bank side. That said, there are ways of packaging something together. We talked about this a little bit earlier, right? We could look at the 504 program or working with VEDA as a possibility to...
Or direct or small business, depending on the specifics of his situation.
Right, exactly. There are ways of packaging it so that we're maybe reduce the cash out of pocket down to as low as 10%, right? So the bank would take 50, we could have VEDA take 40, and then you have 10% cash in. There's a lot that's going on with your particular scenario, so there are a lot of things like, would we appraise at the existing value so that you have to have an appraisal done, and could we appraise at the existing value for the purchase of the building itself, and then have that appraisal done as the complete value if you needed to make modifications for your specific use, and what that value would be like, and there are ways for us to get to that point. But yes, that is a significant amount of cash that you'd have to have out of your pocket, and that's commercial world that happens, so you have to be prepared for that. As far as, go ahead.
Well, one of the things I just want to say is that you bring up a really good point, and often what happens for any of you is, it's very rarely just a straight simple deal, right?
Exactly.
Is often we will all get in the room together and work with you. So we have meetings like this all the time, or Steve might be working with a client and say, I think this is ready to talk with finances, but so Steve might bring the client, or it could come from any of us, and we'll all sit down together with you and say, what's the best way to structure this that works for you so that you can be successful and that we can help you get the financing that you need. So this is a perfect example of where that might happen.
Right.
And so we do try to work together
When you do work together,
Yep.
how does that affect the timeline? From start to closing?
So I can tell you for myself, we can give a pretty quick turnaround. I mean, everybody, let's assume that we have a complete application because that's the, that's what takes the most time. But with a complete application, you know, I have to do a credit write-up. I don't have a credit department, I'm it. I do the loan write-up, probably ask you a few more questions. I go have my committee do it, and then we can close in a few days. So the whole thing could be as quick as a couple of weeks for me. But what we have in other situations, if there's an SBA guarantee, that could take 4 weeks or more from approval, right? It sort of depends on the time, on the program that's
Right.
being used. So everybody will, again, we try to work together and make it happen as quickly as we can, but some things do take longer than others. So if there's certain guarantees, external guarantees, that usually takes the longest.
Generally,
Yeah.
and honestly, and a lot of it, we try to work concurrently as well.
Right.
So it's not like you have point A, in very rare cases, would you ever have point A has to get done, say it's a bank, and then it gets turned over to point B, and then it gets turned over to point C. In some occasions, it is necessary to have that step, but rarely, most of the time, we can actually work on it concurrently, so that helps.
And I find it tends to go better and smoother if we're all working on it together.
Right.
So that, you know, I would say on my case, if I have a complete application, it's probably 2 to 3 weeks to a decision as well. So if we have our 2 to 3 weeks, the same 2 to 3 weeks, and Ian's as well, then that's better. And then, but if there's an appraisal, that usually happens after decision, and that can take 4 to 6 weeks in and of its own.
Right.
Right.
We have some questions.
Yeah, I saw a hand up, Matthew, then we'll go to you.
Okay, yeah, so I have a question about personal guarantees. I work for the Vermont Employee Ownership Center, and we work with a lot of worker co-ops. And this has been a challenge for multiple businesses that we've worked with in that, you know, if you have 25 co-owners who equally own the business, and some own a lot more property than others, figuring out, you know, how to structure some sort of personal guarantee in that context of group ownership can be really challenging. So does anyone have any examples of, for instance, compensating a few individual co-owners in a partnership type situation or worker co-op type situation for taking on that extra risk for the whole group, or suggestions around that, like when it's not a sole proprietor situation?
You could have the limited guarantees where they all guarantee the same amount, right? And that's one
Perhaps.
possibility.
We've done that in some cases. You know, I haven't went to a co-op of that type, of what I think you're talking about, unless it's been like, are these 501c3s?
No, worker cooperatives.
Yeah. I don't know, I'd have to sit down and work through it. I haven't come across it yet.
We had VEDA participate on one loan with the new school in Montpelier.
Okay.
And that was a very small percentage of the deal, but it was again, you know, it's a recurring issue that we see, especially in ownership succession
Yeah.
situations.
And there could be more of that coming down the pipe, so that's sort of great to know about too, right?
Right, yeah.
Yeah.
We're going through one right now. We just started with employee co-op ownership. So I don't have a lot of information on that. It just came through the door a week ago. So, but I certainly could research that and
I'd
get
say
back
call
to
me
you. I can
offline.
talk to you.
Yeah.
Yeah, yep.
Yes.
So this gentleman's scenario here in front of you, except the established business, what should really be the focus on moving forward there? I mean, everything he said is ditto for me, except the established business.
You're not an established business?
Correct.
You're a new startup?
Correct.
Have you, are you working with anybody getting technical assistance, like working with Steve or working with another business advisor at this point?
Yes.
Okay,
Nobody in this room.
yeah, okay, but you're working with somebody.
Yes.
From my perspective as the banker side, and I'm sure most of the panel here would agree, technical assistance, particularly in the startup phase, but even if you're an established business, the technical assistance when you're branching off to a new direction is of great value. The bank is going to ask for, you know, what your business plan is, especially as a startup. We're going to ask you what your business plan is, and we're going to want to review it. And we're going to want to see the financial projections, minimum 2 years. We'd love to see more if you have more. But to be honest, when we get a lot of those projections of the business plans in there, they're something that's been created on your own, and that's great. You may have all of the information about your industry, certainly far more than I might have. However, I don't have necessarily 100% confidence in that unless that we've seen that it was reviewed by a third party, right? An outside party that has no stake in the game, somebody like VPAC, and that assistance is of huge help because it's then, once it's gone through that process, adds some, for lack of a better phrase, legitimacy to it. Our numbers may not have changed at all, but the fact that somebody else has looked at it. Because the banker, the lender, can't say to you like, okay, that's not right, or you didn't think about that, or we can't give you the advice where you have to restructure the information to make it fit what we're looking for. So all we can do is take what's been provided to us. So that technical assistance is, if it's been reviewed, is a huge help. So I would say that to anybody in the room, that definitely make sure that you have access to that and make sure that you use that at any point in time.
And your business advisor
Right, yes, we
should
can.
be able to help you decide when it's time to start approaching funders.
Right.
So when you have something, because and yeah, there'll be lots of questions because they're projections, and you know, your financial statements are the numerical, it's the narrative of the story of your business and your expectations put into numbers. So it's kind of the last piece of the puzzle. There's a lot you have to do before you get to the numbers. So we would have a lot of questions about that if you want to answer.
We do startups, by the way, just so you
Yeah.
know, and for the record, banks do startups. So in many cases, we may add our guarantee for ourselves, that's with the SBA, that helps us give a little bit more comfort level, but it depends on the situation, so, but we do startups.
We do some startups as well in the right cases. We're gonna be taking a lot, we're gonna be taking in any case, but particularly in startup, a look at the management and their ability and knowledge in the field, as well as the collateral.
Right. And before, I'm sorry, I know you've been answered, but I just want to make sure I note that when I talk about the Small Business Administration and the guarantees, that we are a preferred SBA lender, and that question came up about what the time frame was, about from start to finish. As a preferred SBA lender, we are writing to SBA standards in-house, which means we don't need to send our package out to the SBA for approval. When we make the approval, we're making it to the approval of the SBA standards, and therefore that decision is already done. It doesn't add that timeline.
That's great.
Now, do all of you require a business plan for a startup?
We do.
Yes,
Yes.
yes. For a startup.
And you know what, you should have one,
Yes.
regardless of whether you're coming for funding.
So all businesses should have?
All businesses should have it. It doesn't have to be a 50-page, 100-page document. It can be on one page. There's a business model canvas you can use. There's all kinds of simple things. It doesn't have to be onerous.
And particularly in a startup, without a business plan, we don't have a way of knowing what it is that you plan on doing and how.
Or that you've done the research saying that it'll work.
Yeah.
So one last question, and then we'll wrap up. Yeah, sure.
We're a 14-year established business at a growth period. And my question to the entire board is, fifth or fact, do you prefer that we're looking at new or used equipment? Because there's an awful lot of really quality equipment coming out there that's used, and I've been told that lending really prefers that we look at new.
I would say that we don't honestly care whether it's new or used if it's in good shape. What the difference will be is maybe how much we might advance as far as what percentage of that value we might lend to. So the older the equipment, and depending on the life use of that equipment, we might say, okay, if it's $1,000 piece of equipment, but it's older, so it's really only valued at $900, we might lend half of that instead of 75 or 80 or 90% of that. New, we generally would do to the invoice, but older equipment, because it's older and as you retain it, it's worth less and less, we would lend maybe less of what that purchase price might be.
But then he'd bring me in.
But then I'd.
So it's certainly doable.
For us, we've just financed a four-year-old excavator for an excavation outfit and a 6-year-old over-the-road truck for a tractor or a long-haul trucker. So, like Ian said, we'll look at anything. So,
We'll look at anything too, like Ian said, as long as it's in good condition, good shape.
and what the life use is. That's really
Right.
kind
That's
of
a
the
big
key.
piece.
That's a
Right.
big piece, so.
Like a 5-year-old computer, not so much.
Right.
And
I got my phone.
I will just add, I mean, for folks who are in our niche, collateral is important, but it's not, we don't necessarily need collateral. So that's why typically our funds are used for permanent working capital as opposed to for fixed assets, where you can typically get less expensive monies, and we blend in with the things that can be collateralized, like people and marketing costs.
So we're at our 10:30 mark, and I want to thank you all. I want to just make a couple of quick comments. The main thing is, we operate, I think all of us, under this philosophy of there's no wrong door. So you can contact any one of us at any time, and we may not be the person you end up with, but we will always refer you. We are a very collaborative group of people, not just the ones that are here, but throughout the state. We really are committed to helping you succeed. And so you can call any one of us, and we can help you find the resources that you need to keep going forward on that. So take all of our cards and call any of us anytime. I'd like to thank all the panelists that are here. I really appreciate it. So take a look at the table. All the information that we talked about is over there.